we're going to start the conversation not so much on a filmy note, but with Harish Krishnan, co-CIO and head equity at Aditya Birla Sunlife AMC. Harish, nothing stopping you from talking about the movie that everyone's talking about as well. But do you think that that's the kind of year that we can hope for in 2026? Some improvement, some revival?
Yes, it's been a tale of two halves, even if you look at CY25. And we do think that CY26, pretty much the first half is likely to be more positive. There is a lot of negatives which have kind of got digested by the markets. We do think that earnings growth is likely to be revised upwards, and there is going to be a stronger earnings growth coming through, primarily because of the tax cuts as well as the GST cut, not to mention the rupee depreciation. So we do think that from an earnings point of view, things are looking up. The negative at this point of time is the sheer supply of paper that's coming and hitting the markets, and that kind of keeps a lid to the overall macro fundamentals. Of course, the expectation is that we are going to see a trade deal sooner than later. So I don't know whether this fits the filmy style of your show, but I would think that in some sense we do think that things are looking better as we get into CY26.
Harish, in some sense, the Indian markets can say this same piece, right? That ghayal hu isliye ghatak hu, and the returns that I can give over the next 12 months could be very strong because I've underperformed all of EM for the better part of 2025. And I'm a beautiful anti-consensus or an anti-AI trade or an AI hedge if the AI stocks were to come off. The question though, good morning Harish, Neeraj here. The question though, is it that will it take something more than earnings growth for the Indian markets to deliver returns?
I think the single largest negative, Neeraj, is that of the rupee depreciation. And I mean, this is a here and now problem in the sense that, if I am an international allocator investing into India, and if we see, say, a double digit or a low double digit earnings growth in local currency terms, and we are going to see, say, a 7-8% depreciation of the currency, then you're better off being in the US Treasury markets rather than taking all the volatility that India or any equity market kind of offers. So I think the key is that we need to see where the rupee is going to settle at. That's point number one. Now, why is this depreciation phase coming through? I think it's important to contextualize this depreciation phase. Earlier phases of depreciation invariably have happened when India was going through a painful patch. This time around, the macro fundamentals of India are reasonably very strong. And therefore, this depreciation of the Indian rupee is more a function of the trade deal. And this is our release valve at this point of time to help our exporters. So in some sense, it is entirely pinned down by what's happening as far as the US-India trade deal is concerned. So we do think the third aspect, and I think this is an often ignored point, which is that Indian earnings are positively correlated to a weaker rupee. If you look at it, almost 55 to 60% of the top line of India Inc., the top 1,000 companies, are in some sense dollarized. Think about energy, think about metals, think about pharma, think about IT revenues, all of the, even auto ancillaries. A lot of these are in some sense, positively impacted by a weaker rupee. Of course, nobody wants a sharp cut in rupee because that brings its own set of uncertainty. But once the rupee settles down, and that hopefully will be led by some signing of the trade deal, then we would see a lot of these negatives that are today there, primarily courtesy the Indian rupee, kind of unwind. Like I said to the opening question, we are positive on Indian earnings. Indian earnings, given the low base of last year, as well as the tax cuts and the consumption boost, will start looking up. So all in all, we do think that there is a case for being positive on Indian equities. The negative is only the sheer supply of paper that seems to keep coming through. Every 2-5% markets go up higher, you're seeing a new wave of supply of paper. And that really is what is likely to cause a check on a significant move up as far as Indian equities are concerned.
Yeah, the degree of increase at this point. Harish, good morning. Alex here. So I've been speaking to a number of people who also believe, like you do, that the earnings in the coming year is going to be better. But I'm just wondering what you think that's going to be driven by. And you've spoken to a certain extent about the implications of the weaker rupee. But I'm hearing that the top line growth has been anemic. And based on your domestic factors, there's no reason for that to change. And we've seen earnings improve in the second quarter for a basket of companies, but that's been driven by margin improvement. So do you see that that's going to change in FY27?
Yeah, so I think hinge to all of these is the fact that we are witnessing very low inflation. We think that the pump priming of the Indian consumer, which is the bedrock of Indian economy, close to about 60% of the Indian economy is linked to the consumer, and the significant stimulus measures that have been given should bring in demand resurging for the Indian economy, and with that there will also be some amount of inflation coming back up. Also, do keep in mind that we're going through a very low base of Indian inflation. That will also add positively to the numbers. So you're right. All the heavy lifting for Indian earnings has come courtesy the margin profile, which corporate India has done quite well. The fact that you're going to see a rupee depreciation, which is a positive tailwind for Indian revenues. The fact that you're likely to see a higher inflation print, given the low base, as well as the stronger consumer demand, which is likely to come through given all of these tax cuts. Both of these are likely to take the top line growth higher. So even as margins may come off a bit, we do think that that's going to be cheered by the Indian equity participants, which has been a bit worried given the fact that top line growth has been subdued for quite some time.
This is so good to have as we close out the year, I mean last 16 days of the calendar, that we get the view from Harish Krishnan on markets for 2026. Harish, we hope to do an encore somewhere between now and the budget to get a sense of how is it the year is starting off, what are the budget expectations, etc. But for today, thank you so much for taking the time out and being with us.
Thank you so much.